A major read on consumers out this morning. Not only did the final read for consumer sentiment in April come in better than expected, but it confirms the idea that Americans see better days ahead. The read on current conditions declined more than 29%, down more than 40% in the past 2 months. And then you look at that, juxtaposing it with the read for how we see the economy in 6 months. That's only down 12%, 22% in 2 months. So it's pretty clear that consumers and the stock market are banking on this economy reopening soon and the coronavirus continuing to flatten. Now, many are wondering, though, has the market still come too far too fast? And are consumers and investors being too optimistic? I want to bring in two of the best to discuss this. Kingsview Wealth Management CIO and Fox Business contributor Scott Martin, SureVest CEO and Chief Investment Strategist Rob Luna. Scott, I know a lot of folks are confounded at the market rebound, and even today, when this Michigan sentiment number came out, some economists are saying that people just are overly optimistic that it's just not going to work out this way.
Yeah, and it's fair to be confounded in this crazy market environment, certainly in this crazy kind of world environment. So that's a fair feeling, to be redundant there. But the reality is this, Charles, as we kind of have talked about over the last several weeks with Rob, this has gone from that fear trade that we saw, say, when oil crashed in February and took the markets down big time, a couple hundred points or so in the S&P that one Monday, to now the hope trade, which is that we're starting to see the light at the end of the tunnel. We're getting pretty sure that it's not another train. It is the end of, say, the tunnel, and the fact that we are going to come out into better weather here. And that's why, as an investor, you've got to try to take these opportunities when things do pull back, when bad data does come in and, say, push the markets down for, say, half a day or so. Take some of those stocks off that buy list and actually put them in your portfolio, because that's how you're going to see some growth here, I believe.
Yeah, I got to tell you, Rob, it feels like, I'm looking at these key resistance numbers, and it feels like we're building up. What I'm seeing since that rebound, the 50% retracement of the crash, is classic consolidation. And to me, maybe the question is, what will the leadership look like? But it's pretty fair to say that this market's holding up a lot better than anyone anticipated, and maybe, just maybe, hinting at a next big move to the upside.
Yeah, no, I think that's it, Charles. I'll be the first to admit I didn't think we would get here this fast. That being said, we're right at about the 2,800 level, and you have to ask yourself what's going to be the catalyst. That catalyst is going to be the successful reopening of America, and how fast is that going to happen? But I would caution some investors, everyone's been pushing into this index trade for the last 5 to 10 years. There's some companies that are not going to make it through here that are getting lifted up with the index. I think, to Scott's point, you should be buying on pullbacks, but I don't think you should be buying the index. I think you should be looking for the winners coming out of this, the stocks that are performing well, even in this environment. We own a stock, everyone's talking right now, Charles, about dividends being cut, especially for the financials. Look at People's United this morning. They just reported their 27th consecutive year of dividend increases. These are the types of things you want to be looking at a market like this, not buying the overall index.
Right. It's so funny. I did a report on that over the weekend on the dividend aristocrats, companies that have raised their dividend 25 years and more. And so far, most of the names that have hiked their dividends in this earnings season have gone higher. I want to pick up on what Rob was saying with you and Scott, with the idea of President Trump talking moments ago and throwing some ideas out there, maybe the federal government buying long-dated or WTI, West Texas Intermediate, these future contracts to provide some stability there. In the meantime, though, we've seen where individual investors have taken a drubbing. Some people are telling me they couldn't even get out of their contracts earlier this week because they had a negative sign and their sites that they dealt with weren't prepared for it. So the role of these ETFs for investors from going forward.
Yeah, the role is going to be interesting because, as Rob said, you're going to get a lot of good with the bad. Now, gosh, Charles, talking about the government going out and buying long-dated crude, whether it's calls or actual futures, gosh, that's risky business, my friend, which is actually one of my favorite movies, so plug there. But here's the thing. I'm all for buying stuff, like Rob said, that does pull back hard. We've seen that in some of the pharmaceutical companies. Saw that in Gilead yesterday as an anecdote. We've seen that in, say, like Occidental Petroleum earlier this week. But just remember, as an individual investor, those are probably more trading type opportunities. So don't leave it, say, hanging out in the wind too much with respect to some of that really speculative money, because when that stuff does bounce for you, that's when you have to take profits and wait for it to rain again and then go back in when the sun comes out.
Rob, real quick, what's our biggest risk right now as we head into these summer months and possibly a summer rally?
Yeah, I think I'm out here in Los Angeles, and we're still very unclear when things are going to reopen back up. I think the biggest risk is that we stay closed for longer, or even a larger risk is that we reopen and have to shut back down. I think that's what everyone's concerned about right now, Charles.
Scott, Rob, guys, do the best. Appreciate it. Have a great weekend. We'll talk to you again real soon.